Hi everybody, this is Phil Holoka from Complete Captive Management Services, and today we wrap up the collateral versus capital conversation with how do employers account for collateral or capital. Well, this is important because all too often consultants like to lump together the premium that the client is going to pay into the captive or a fronting carrier and the capital or the collateral. A lot of times the consultants lump those two numbers together to get a net value, which they then present to the employer. And they say, to join the captive, you've got to pay X. Well, that's not entirely right. Yes, the employer has to pay two items, but you can't make those two items become one item, okay? So these two are simplified P&Ls. One is right, one is wrong. So let's talk about the wrong one first. Whether it's collateral or capital, let's assume for a minute that the employer generates $1 million of top-line revenue. They sell goods, whatever they collect from the sale of those goods, that's top-line revenue. To manufacture those goods, the cost of goods, it costs the company $200,000. So what you got to do, very simple math, is net these together and you come out with $800,000. Yes, it's simple. It gets more complicated here in a second. So from there, you take your SG&A expenses, your sales, general, and administrative expenses, and let's call that $600,000. Let's also call premium expense, which is premiums to buy the insurance policies, at $100,000. And then most consultants will say, oh yeah, you got this collateral obligation, so your total cost of coverage in the captive is $120,000, okay? If you back out all of these expenses, you get $80,000 of net income. Now, if you're a C corporation, today your income tax rate is 21% of income. Therefore, you multiply 21% with $80,000, you come out with $16,800, and that is what's due to the IRS as income tax, leaving you with $63,000 of what we'll call retained earnings. You brought in $1 million, and after everything is paid and said and done, you're walking away with $63,000. That's the cash in your bank account. Well, that's not right. That's the not right way to do this. The correct way is you take $1 million, you earned $1 million, you back out your COGS, cost of goods sold, $800,000, you pay your premium, you pay your SG&A expenses, but look, this is not a qualified business expense. Therefore, you didn't make $80,000 of profit, you made $100,000 of profit, and now you have to multiply $100,000 by 21%, the C Corp tax rate. So now you're paying the IRS $21,000 because you made $100,000. That nets you down to retained earnings of $79,000. Now you're going to say, no, wait a minute, that's even better. Well, not necessarily, because now you've got to take out the capital or the collateral of $20,000 from $79,000. So this value, $59,000, is the actual cash that you have available in your bank account. In this example, there's a $4,200 difference because you short paid the IRS your tax obligation, and that is you short paid $4,200. Okay? So this is wrong on several different fronts. Okay? If you short pay your tax and they discover it, there will be interest and penalties for not paying the right amount. Okay. If you recall from last week, I translated capital with equity, and that's the way it is. If your captive collects equity or collects capital, that $20,000 flows to the captive's balance sheet. So your captive now has cash in it, $20,000. That's an asset. You back out your liabilities, which in this case you don't have any. So that means because your balance sheet has to balance, assets minus liabilities equals equity, now you've got $20,000 of equity in your captive insurance company. So, if you recall, collateral goes to the fronting carrier. Capital, if you're in a fronted captive, you may pay $20,000 of capital, but the fronting carrier may ask for $15,000 of collateral. Therefore, you're going to pay $15,000 of collateral, and your captive's going to retain $5,000 of cash and equity. Okay? So, very similar exercises. This is not right. So, consultants do not net premium and capital together to get a cost that could be misrepresented to the employer as a qualified business expense, which collateral and capital is not. Okay. Thank you for watching. I hope this was informative. We'll see you next week. Bye now.